Today, January 30th, silver crashed hard, down over 15% in hours. Brutal selling. But here's what nobody's telling you about this crash. It was predicted by history. In the last 52 years, silver has only done something very specific twice before this. February 1974, December 1979, and now January 2026, 3 times in half a century. What I'm about to show you will explain exactly why this crash happened today and what comes next. Because history has two outcomes for this pattern. One created generational wealth for those who held. The other time, it trapped investors for 5 years. Same setup, completely opposite results. Right now, we're living through the third occurrence. Most people are panicking and selling at the bottom. By the end of this video, you'll know which pattern we're following, 1974 or 1979. This matters. The next 30 days will define the silver market for the next decade, so pay very close attention. Drop a comment with silver if you're watching this crash. Hit that like button right now. Let me show you what happened. Silver was around $110 yesterday, then chaos hit today. Today it crashed to $95, over 15% gone in one session. Violent, relentless selling pressure. Social media is exploding with panic. Everyone is asking, is this the top? Did we just witness the end of the silver bull market? Should you sell everything right now? Here's what you need to understand. This crash is part of a historical pattern. January 2026 just became the third time ever that silver gained 65% in 1 month, ever. Think about that number, 65% in 1 month. That's not normal market behavior. That's parabolic. And parabolic moves always end with violence, with crashes, with massive fear spreading everywhere. The 2 previous times this pattern occurred led to completely different outcomes for investors. Let me take you back to December 1979 first. This case study is absolutely critical to grasp. Silver had been rallying hard for months. The Hunt brothers were accumulating massive positions. Inflation was raging across America, double-digit inflation destroying people's purchasing power. The dollar was under siege. Silver looked unstoppable as prices kept climbing every single day. In December 1979, silver gained exactly 65% in 1 month, just like what happened in January 2026. The chart went completely vertical. Every single day was a new high. The mainstream media went insane. Magazine covers featured silver. News anchors talked about silver. Everyone became a silver expert overnight. There was this feeling that the old rules didn't apply. Silver was going to $100, maybe $200. Now, some people will say that was the Hunt brothers. Different situation, but patterns repeat. Human psychology doesn't change. Greed in 1979 feels the same as greed in 2026. FOMO is identical. So, what happened after December 1979's 65% gain? This is where the story gets absolutely fascinating. Silver didn't stop. It kept pumping. January 1980 saw another massive gain on top of December. Another 35 to 40% gain in just 1 month. Think about that. 65% in December, then 40% more in January. Back-to-back months of insane gains. Silver peaked at around $50 per ounce on January 21st, 1980. That specific day marked the exact top, the absolute peak of the entire move. What happened next was brutal. Silver didn't pull back. It collapsed. Not a normal correction. A complete devastating crash. In the following weeks and months, silver dropped from $50 down to single digits eventually. The speed of the decline was breathtaking. People who bought near the top weren't just losing money. Many of them were completely wiped out. Leveraged traders got margin calls they couldn't meet. Fortunes that took years to build evaporated in days. The psychological damage was catastrophic. The crash was so severe that the government had to step in and change the rules on commodity trading. The Hunt brothers eventually went bankrupt. It became one of the most studied market crashes in history. And here's the truly remarkable part that most people don't fully appreciate about what happened next. That $50 high from January 1980 stood as the all-time record for 45 years. 45 years? Almost half a century. Silver tried to break it in 2011 and got to $49 but couldn't push through. That $50 level wasn't just a price. It was a psychological barrier burned into collective market memory. Everyone who studied commodities learned about 1980. Everyone remembered the crash and the pain it caused. That structural resistance was so strong it took until this current rally to finally break through. We are now trading above that historic $50 level for the first time in 45 years. New all-time highs. So let me apply this to today. If January 2026 mirrors December 1979, we just had our 65% month. And if the pattern repeats, February 2026 could see another 35 to 40% gain from current levels. Let's do the math together. Silver crashed today to $95. If we get a 35 to 40% pump from here, that puts silver somewhere between $128 and $133. That's not a prediction. That's just arithmetic. But here's where my analytical opinion comes in. I believe if we reach those levels, maximum caution is needed. At $130 to $140, monthly indicators would be screaming. Sentiment would be universally bullish everywhere. Everyone would be calling for $200 silver, $300 silver. And that's exactly when tops typically form. When everyone is bullish, when nobody can imagine prices going down, that's when reversals happen. In my view, if silver rallies from this $95 crash back up to $130, $140 zone in the next few weeks, that would be the 1979 pattern playing out. And if history repeats, a devastating crash would follow. Not immediately, but soon after. Just like January 1980 peaked and then collapsed within weeks. This crash we saw today, it might not be the end. It might be a shakeout before one final explosive leg up. That's what happened in 1979. Volatility, crashes, recoveries, then one final parabolic move to the top. The people who bought at $50 in 1980 thought they were geniuses. They thought silver was going to $100. They had no idea they were buying the top of a 45-year cycle. Don't be that person in 2026. Now let me show you the second scenario. February 1974. This outcome was completely different. The macro backdrop was similar in some ways. Silver was in a strong bull market, climbing higher. Inflation concerns were rising across America. The dollar was under pressure after Nixon ended gold standard. In February 1974, silver gained exactly 65% in 1 month. The exact same percentage as December 1979. The same percentage we just saw in January 2026. Everyone expected continuation. Everyone thought moon. The setup looked nearly identical to what would later happen in 1979. But what came next shocked everyone. There was no 35 to 40% follow-through month. There was no blow-off top, no spectacular crash either. Instead, something more frustrating happened. Something that tests investor psychology in a different way. Silver entered a long consolidation period. For the next 5 years, silver went essentially sideways. It traded in a range, up a little some months, down a little other months, but never breaking out higher. 5 years of nothing. Think about what that means for an investor holding a position during that time. 5 years of frustration. 5 years of sideways chop, while other assets were making money elsewhere. Many people gave up during this period. They sold out of boredom, out of needing capital for other things. They sold because they lost faith that silver would ever move again. The media stopped covering it entirely. The excitement faded. People moved on to other opportunities. Silver became boring. Nobody wanted to talk about it. And then in late 1979, silver finally broke out of that 5-year consolidation zone. And when it broke out, it went absolutely vertical. That breakout led to the 1979-1980 blow-off top we just discussed in detail. So the people who held through 5 years of nothing were eventually rewarded massively beyond imagination. But it required patience that most humans simply don't have. Most people can't hold for 5 years with no gains. It required conviction when there was zero positive reinforcement from the market, no green candles to keep you motivated. It required holding when everyone else had given up and moved on to the next hot investment. Same 65% monthly gain setup, same historical rarity. Completely opposite outcome compared to 1979. One led to an immediate blow-off top and 45-year crash. The other led to 5 years of pain, then glory. So which scenario are we in right now? That's the million-dollar question. Literally could be worth millions. Here's my thinking on this. I believe we are more likely following the 1979 outcome than the 1974 outcome. The velocity of this move is more similar to 1979. The speed, the violence, the parabolic nature of it. The level of retail participation is more similar to 1979. Social media is exploding. Everyone is talking about silver. The macro backdrop with inflation concerns and dollar weakness also resembles 1979 more than 1974. But I could be wrong. Markets have a way of humbling everyone who thinks they've figured everything out. What I'm confident about is this. If silver recovers from today's crash and pushes to new highs above 121s, the probability of a significant top forming in the $130 to $140 zone increases dramatically in my view. That's the zone I'm watching very carefully. Not because tops are predictable, they're not, but probability matters. Now let me talk about something more important than any price level, your psychology during this crash. Right now, this very moment, the market is experiencing extreme volatility. This isn't a malfunction. This is normal behavior for parabolic moves. When price advances this fast, corrections are violent. The market is filled with leveraged positions, stop-loss orders, algorithmic trading systems crashing everything. All of these factors combine to create price action that whipsaws people out of their positions brutally. Here's what happens to most retail investors during periods like today. And I want you to examine yourself honestly. Price was going up last week. You wanted to participate so you didn't miss out. You bought near the highs. Then immediately after you bought, price drops 15% in hours. You're suddenly underwater and panicking badly. You sell to stop the bleeding and protect what's left. Then price recovers and makes new highs tomorrow. You feel like you made a mistake selling. You buy again at higher prices. Then price drops again violently. You sell again in panic. This cycle of buying high, selling low, destroys wealth. This is how money transfers from emotional investors to patient ones, every single day without fail. Your fear and your greed are literally the fuel that sophisticated traders use to extract profit from you. When you panic sell at $95 today, someone is buying from you. When you FOMO buy at $120, someone is selling to you. If you're making these emotional decisions, if you're reacting to every price swing with fear or greed, then you are the exit liquidity that professional traders need. You're being harvested. Your emotions are weaponized. I don't say this to be harsh. I say it because recognizing this pattern is the first step to breaking it. The only way to avoid being exit liquidity is to have a plan before volatility happens, before crashes occur. Know at what level you'll take profits. Know at what level you'll add to positions. Know your pain threshold. If you don't have this plan written down and thought through before prices start moving, you will lose. You will make emotional decisions at exactly the wrong times, buying tops, selling bottoms, losing money repeatedly. Let me give you practical frameworks for thinking about today's crash and what comes next for positioning. If you're holding physical silver for long-term wealth preservation, today's crash is largely irrelevant to you. Physical silver held outside the financial system isn't a trading vehicle. It's multi-decade insurance against currency collapse. Whether silver goes to $140 next month or consolidates at $95 for 5 years doesn't change the thesis. Physical holders should focus on accumulation over time, not trying to time every top and bottom perfectly. If you're trading silver through futures or leveraged products, this is the most dangerous environment possible right now. Volatility will destroy accounts that are over-leveraged. A 30% drawdown will wipe out 3 times leveraged positions. If you can't handle large drawdowns without getting margin called or panic selling, you shouldn't use leverage here. Too many traders get wiped out in bull markets because they're over-leveraged when volatility shakes them out. Now here's what I believe happens next, and this is where it gets really interesting for positioning. Today's crash to $95 was violent, but I don't think this is the final bottom. Here's why. If we're following the 1979 pattern, this crash is a shakeout before one final explosive move higher. Look at what happened in late 1979 before the final push to $50. There were massive corrections. Days where silver dropped 10%, 15%, even 20%. Traders got liquidated. Weak hands sold in panic. And then silver recovered every single time and pushed to new highs until the final peak in January 1980. So if history repeats, we could see silver recover from this $95 level over the next few days or weeks. It could push back above $110, then $121, and eventually reach that $130 to $140 danger zone I mentioned. That would be the 1979 pattern playing out perfectly. One final parabolic leg up after a violent shakeout. But here's the critical question. What if I'm wrong? What if this crash continues lower from here? In a worst-case scenario, where could silver fall to? This is important for anyone thinking about buying this dip. Based on the structure of this rally and previous support zones, I believe the absolute floor is around $70. That would represent a brutal 35% drop from today's $95 level, even worse from the recent $121 highs. But it would still be well above where silver was trading just 1 year ago. The floor has been permanently raised. I do not believe silver goes back to $30 or $40. Those price levels are gone forever, in my opinion. Even in the most bearish scenario, even if everything breaks down completely, $70 seems like the bottom. Anything below $70 would be an exceptional buying opportunity. Generational wealth building type of opportunity. So you have the range now. Upside potential to $130, $140 if the 1979 pattern plays out with one more leg. Downside risk to around $70 if we enter a 1974 style consolidation, or if this rally completely breaks down. That's a risk-reward ratio you can actually work with. You can build a strategy around those parameters. Here's my personal framework, and I want to be very clear, this is not financial advice. This is education. If silver recovers from $95 and pushes above $121 again, I would be watching the $130, $140 zone very carefully. At those levels, I would consider taking profits on trading positions, not selling everything, scaling out gradually. Taking some money off the table at extended levels locks in real gains while maintaining exposure if it continues. If silver breaks down from here and falls toward $80 or $70, I would view that as a buying opportunity. Not all at once, not going all in at one price, but dollar cost averaging down at those deeply oversold levels. The key is having a plan for both scenarios, not getting caught off guard by whichever direction the market chooses. Most people will do nothing with this information. They'll watch prices, get emotional, buy high, sell low. Some people will get paralyzed by information overload. Too many scenarios. They'll freeze and watch from sidelines. But some of you will use this to build an actual plan. You'll know your levels. You'll execute calmly. That's the difference between retail investors who get harvested and sophisticated ones who build wealth over time. Before I wrap this up, I need to be very clear about something critical. This is extremely important. I am not telling you what to do. I am not giving you financial advice. I cannot do that. Everything I've shared is my personal opinion based on historical pattern analysis. That's it, nothing more. I'm showing you what happened in 1974 and 1979. I'm giving you my view on which pattern we might follow. But I could be completely wrong. Markets don't follow scripts. They don't care about historical patterns. Silver could do something entirely different that's never happened before. That's always a possibility. You should never make investment decisions based solely on what someone says in a YouTube video, ever. I don't know your financial situation. I don't know your risk tolerance. I don't know your goals. What makes sense for me might be completely wrong for you. Only you can decide what's right for your situation. If you're thinking about buying or selling silver, talk to a qualified financial advisor first. Seriously. Someone who knows your complete financial picture and can give you personalized advice based on your needs. My role here is education, showing you historical context, helping you think through possibilities and probabilities. But the decisions, those are 100% yours. You are responsible for your own money and your own choices. Don't blame me if silver crashes to $50. Don't credit me if it goes to $200. I'm not your advisor. I'm just a guy analyzing patterns and sharing my perspective. My opinion could be totally wrong tomorrow. Now, with that disclaimer very clear, let me summarize what we've covered today about this crash. Silver crashed 15% today on January 30th. This isn't random. It's part of a rare historical pattern. Only 3 times in 52 years has silver gained 65% in a single month. 1974, 1979, and January 2026. After 1979's 65% gain, silver pumped another 40% to $50, then crashed and didn't recover for 45 years. After 1974's 65% gain, silver consolidated sideways for 5 years, before eventually breaking out massively. In my opinion, based on velocity and retail participation, we're more likely following the 1979 pattern. If that's true, today's crash could be a shakeout before one final explosive leg up to $130, $140. But if I'm wrong and we're in the 1974 scenario, We could see months or years of consolidation from here. The worst-case downside, in my view, is around $70. I don't believe silver goes back to $30 or $40. These are the parameters I'm working with. But again, this is just my opinion, not financial advice. The next 30 days will be absolutely critical for determining which historical path we're actually following. If you found this analysis valuable, drop a comment. Let me know which scenario you think we're in. Are we in 1974 or 1979? Do you think today's crash is the beginning of the end or a shakeout? And if you're not subscribed, hit that button right now. The follow-up analysis is coming soon. What we're witnessing is historic. Only 3 times in 52 years has this pattern appeared. The decisions you make in the next 30 days could define your financial outcome for years. Stay informed, stay rational. Don't let fear or greed make your decisions for you. This crash today, it's not random, it's history speaking, and if you listen, you'll be ready. I'll see you in the next video where we'll track which scenario unfolds in real time.